Margaret paid $4,800 in taxes last year that she did not have to pay, not to the IRS, to her state, on money she had already paid federal tax on. She had no idea it was happening. She did not receive a letter explaining it. Nobody called. It just showed up on her tax return, a line she did not understand, and her accountant explained it to her for the first time at age 68. She had been living in Minnesota for 31 years. She had been collecting Social Security for 3 of them, and for 3 years, her state had been quietly taxing those benefits on top of everything the federal government already took. She was not alone. In 5 states right now, retirees are losing an average of $5,000 a year to a tax most of them have never heard of, a state-level tax on Social Security benefits, on top of federal taxes, on the same check. This video is going to name the states, show the real math, and tell you what you can actually do about it. Most retirees know that the federal government taxes Social Security. Not everyone, but most. If your combined income, your adjusted gross income plus half your Social Security benefits, exceeds $25,000 as a single filer or $32,000 as a married couple, a portion of your benefits becomes federally taxable, up to 85%. That rule has been in place since 1984. Most financial advisors mention it. Most retirement articles cover it. What almost nobody mentions is what comes next. 8 states are adding their own tax on top of that federal tax. West Virginia just finished phasing theirs out. Nebraska eliminated theirs in 2025. Missouri eliminated theirs in 2024. The trend is moving in the right direction. But for retirees in the states still doing it, the money is still leaving their accounts every single year. And most of them have no idea. Here is why it matters in real dollars. The average Social Security benefit right now is $2,076 a month. That is just under $25,000 a year. For a married couple where both spouses collect the average benefit, that is approximately $49,000 a year in Social Security income. In a state that taxes those benefits, a meaningful portion of that $49,000 gets taxed twice, once by the federal government, once by the state. The combined hit for many retirees in these states runs between $3,000 and $6,000 a year, money they worked 35 years for. Money they already paid into the system, taxed again at the state level, without ever being told it was going to happen. Minnesota. Minnesota is one of the strictest states when it comes to taxing Social Security. The state taxes Social Security benefits that are already subject to federal tax, and offers a subtraction that phases out as income rises. For married couples filing jointly, the full subtraction is available only if adjusted gross income is below $110,780. Above that, the subtraction shrinks 10% for every $4,000 of additional income. Once a married couple's AGI exceeds approximately $150,000, the subtraction is gone entirely, and Social Security benefits are fully included in Minnesota taxable income. Minnesota's top income tax rate is 9.85%. That is one of the highest in the Midwest. For a couple with a modest pension and Social Security, crossing that threshold by even a small amount means their benefits are taxed at rates most people associate with high earners. Minnesota has been debating full repeal for years. As of 2026, it has not happened. Connecticut. Connecticut taxes Social Security benefits, but with thresholds that protect many middle-income retirees. Single filers with adjusted gross income below $75,000 pay no state tax on their Social Security. Married couples filing jointly with AGI below $100,000 are also fully exempt. Above those thresholds, up to 25% of benefits can be taxed at Connecticut's state income tax rate. Connecticut's cost of living is among the highest in the country. which means the income thresholds that look protective on paper can be reached faster than expected, especially for retirees who have pension income alongside their Social Security. Vermont. Vermont has some of the lowest income thresholds of any state that taxes Social Security. Single filers with AGI above $55,000 begin to lose the full exemption. Married couples filing jointly lose it above $70,000. For a married couple both collecting the average Social Security benefit, their combined check alone comes close to that threshold before adding any other income. A pension, a part-time job, an IRA withdrawal. Any of those can push a Vermont retiree over the line. Vermont's income tax rates run up to 8.75%. For retirees on modest fixed incomes, Vermont is one of the most expensive states in the country to collect Social Security. Colorado. Colorado's rules depend heavily on age. Retirees 65 and older are fully exempt from state tax on their Social Security benefits regardless of income. But retirees between 55 and 64 face different rules. For that age group, a full exemption is available only if adjusted gross income is at or below $75,000 for single filers or $95,000 for married couples. Above those thresholds, only $20,000 of Social Security income can be excluded. The rest is taxable. For someone who retired early at 62, this matters significantly. 3 years of state-level taxation on Social Security before the full exemption kicks in at 65. New Mexico. New Mexico has some of the highest income thresholds of the 5 states, which means many retirees there are protected. Single filers with AGI up to $100,000 pay no state tax on Social Security. Married couples filing jointly are exempt up to $150,000. Above those thresholds, benefits are taxed at New Mexico's state income tax rate, which ranges from 1.7% to 5.9%. New Mexico has seen significant retiree migration from Texas and California in recent years. Many of those retirees moved without knowing the Social Security tax rules. They arrived expecting a lower tax burden, and for most of them that is true. But for those whose income exceeds the thresholds, the tax exists, and it is not small. Let me put a real number on what this means for a typical married couple. Take 2 retirees, both 67, both collecting Social Security. Combined benefit, $3,800 a month, $45,600 a year. They also have a small pension of $18,000 a year. Combined income, $63,600 a year. In Florida, they pay 0 state income tax on any of this. In Minnesota, their combined income puts them above the exemption threshold. A portion of their Social Security is now included in Minnesota taxable income. At Minnesota's applicable income tax rate, the additional state tax on those benefits runs approximately $4,000 to $5,000 per year. Same income, same Social Security check, same Medicare premiums, different state, $5,000 difference. That is the number. And for retirees who have been living in these states for years and have never been told this rule exists, it has been adding up year after year without their knowledge. Missouri eliminated this tax in 2024. Nebraska eliminated it in 2025. Their retirees stopped paying it. The retirees in the 5 states covered here are still paying it. There are 3 things worth doing depending on where someone sits right now. The first applies to anyone who has not yet retired. Where you retire is a tax decision, not just a lifestyle decision. 41 states do not tax Social Security benefits at all. Florida, Texas, Nevada, Arizona, Tennessee, Georgia, South Carolina. For a couple paying $5,000 a year in state Social Security tax, moving to one of those states before retirement is worth $5,000 every year for the rest of their lives. Over 20 years, that is $100,000. That is a decision worth making deliberately rather than by default. The second applies to retirees already in one of these states. The key is managing provisional income, the number states use to determine how much of Social Security is taxable. Provisional income is roughly adjusted gross income plus tax-exempt interest plus half of Social Security benefits. Every dollar that can be kept out of that calculation is a dollar that reduces how much Social Security gets taxed. Roth withdrawals do not count toward provisional income. Qualified charitable distributions from an IRA do not count. For retirees who are already drawing from traditional IRAs, the source of the withdrawal matters as much as the amount. The third is the most important for people in any of these states. Know the actual number. Most retirees in these 5 states do not know how much they are paying in state Social Security tax. They see their net check. They do not see the line item that came out before it. Running the actual calculation, or having someone run it, is the starting point for every other decision. Margaret found out. 2 years after she started collecting Social Security, she finally understood why her tax bill was higher than she expected. She worked with her accountant to restructure how she was drawing from her IRA. By shifting some withdrawals to her Roth, the one she had converted into years earlier, she brought her provisional income below Minnesota's exemption threshold. She did not move. She did not do anything dramatic. She just knew the rule. That is the only difference between her now and her a year ago. The 5 states covered in this video are not doing anything illegal. The taxes are on the books. They are public information. The problem is not that the rules are hidden. The problem is that nobody explained them to the people paying them. And for retirees on fixed incomes, $5,000 a year is not an abstraction. It is the difference between a comfortable year and a stressful one. This channel exists to close that gap. If this video gave you something you did not have before today, subscribing means you will not miss what comes next.